Hello and welcome to PQ Prime. The Monetary Policy Committee delivered its June policy review. As expected, rates were hiked by 50 basis points, so at the upper end of the expectation of rate hikes. And there was a fairly clear sort of stance coming through in the monetary policy resolution, saying that they are now focused on withdrawal of accommodation. So a clean and clear policy, as I would put it. Let me go across to Ananth, Narayan and Kaushik to get more insights into what we should read into the policy and the comments that followed. Thank you both so much for taking the time to speak to us. Ananth, I'll start with you. Clean and clear in the sense that, with words, very clearly saying that, we are in a rate hiking cycle, which is perhaps going to go a distance beyond where we are right now. A fair way to describe it?
I think so, Ira. So my quick takeaways resonating with what you mentioned. By the way, I think the market was a bit relieved because in the recent last couple of days, there was a fear that the RBI might tilt towards either a 75 basis point rate hike or a CRR hike. So there was some relief, but otherwise, I think the message was very clear from the governor. Worried about inflation, not so worried about growth, I thought. He seemed a lot more sanguine about growth. The inflation projections going up to 6.7% is obviously a big hike up from the last 5.7%. Even so, unfortunately, I think they are still understated. I think inflation could be higher than 7%, particularly the second quarter for this fiscal year, where they have penciled in 7.4%. I think there's a risk that we might actually cross 8% at that point in time. Of course, a lot depends on oil prices, etc. So inflation remains a worry. They've highlighted that. I think we're going to stay in a rate hiking cycle for the next couple of policies at least, so both August as well as October, because inflation will peak around September or so. So I guess they continue with the rate hike. Maybe they continue even into December, just to sort of clear out all the excesses. So we could end at 5.75-6. The market, by the way, continues to price in a terminal rate of 7% on the repo over the next 1 year. I don't think the RBI and MPC is there yet, or they're hoping hard that that is not required. But they'll probably take a fresh view after the peak of inflation has been seen around September, October or so. So that's the takeaway there. In terms of, I guess, liquidity and stance, they've clarified the stance. Thank God for that. We don't have this confusing, still accommodative kind of nonsense yet, persisting. On liquidity, there still is some confusion, I guess, because some market participants feel that liquidity will probably disappear by December end or by March. But the governor continues to say that he will keep, the unwinding will take 2 or 3 years. So there seems to be some confusion on that score. But otherwise, yes, clarity, rate hiking cycle continues at least till October. And inflation is clearly the primary worry at this point in time.
Kaushik, your first thoughts?
I think Ananth has summarized the points pretty well. And it's, as you said, it's a very clean and clear-cut policy where RBI is focusing on bringing down inflation. And 50 basis points was the minimum that we were expecting from RBI. In fact, I had written that probably RBI can, give us 60 basis points as well, as Jan Verma had argued that since they had given 40 basis points, if they wanted to, kind of round it off to 100 basis points for April-June quarter on the repo rate hike, a 60 basis points wouldn't have made that much of a difference. Similarly, they could have given 50 last policy and 50 this policy, so that would have done the job. But doesn't take away the fact that RBI has become more hawkish on inflation, and which is reflected in the inflation forecast that they've given. I agree with Ananth that still the risks are to the upside. Our own CPI inflation forecasts are close to 7%. We have 6.9. But RBI has raised it by 100 basis points. And if you take it from February, RBI has raised it by 220 basis points, which has also been the case with professional forecasters. So there has been a steep increase from February onwards. Now the thing is that if you look at the inflation forecast, it's kind of interesting that they have taken about 7.4, 7.5% forecast for April to September. And then October to March, they're taking 6% on an average. Our forecast is about 7.2 in April, June, and 7.1% or 7.0% in July, September. But then staying at 7% for October, December, and going down to 6.5%. So, our forecasts are actually lower in April, September compared to RBI's by 30, 40 basis points. But the second half, our forecast is about 675 average, whereas RBI is at 6%. So on an average, we are still higher than RBI's 6.7, closer to 7%. And as Ananth said, you just need 1 month of bad data and you can easily see inflation above 7% average. So that risk is there. But RBI has recognized most of this risks which were there in the system, and to some extent the mark to market has been done. On the stance, I'm happy that they've changed the words, that dropped the words accommodated. But I think going forward, once they reach the 515 level or higher than that, the pre-pandemic level of repo rate, this withdrawal of accommodation needs to be tweaked further, and they can move into something like saying calibrated tightening, because for the next few policies and quarters, RBI will continue to hike interest rates. So why not call it calibrated tightening? That can actually improve the forward guidance efficacy, in my view.
That's a good point, actually, Ananth. I mean, we would probably skip over neutral and go straight into calibrated tightening if we are talking about moving towards a positive real rate. Is that the way to read them, removing accommodative as a first step towards perhaps going to a calibrated tightening stance?
I think they're keeping their options open, Ira. Look, as of now, at 4.9% repo rate and surplus liquidity at close to 4 lakh crores, they're still clearly in accommodative mode, irrespective of what they actually say. So withdrawal of accommodation makes eminent sense at this point in time. Now, if you go into a tightening mode, you're promising more and more rate hikes, even beyond what you would consider to be a neutral rate, let's say 5.5, 5.75, 6, right? So I think before they commit to that, they will want to see what inflation trajectory looks like. It's very clear they go towards 5.5, 5.75 by October or so. And then they probably want to take a deep breath and figure out what's happening to commodity prices, to growth, to inflation, and then take a fresh view on things. I don't think they're trying to jump into a let's move from withdrawal of accommodation to a tightening stance right away. They want to take a deep breath. They have room and space while they're still accommodative before they decide which way they're actually headed once they get into a neutral zone.
Can I make a point here regarding this? Couple of things. One is, normally you would have expected RBI to move from accommodative to neutral. But here the problem is that if you say neutral, neutral can also mean possibility of a rate cut. So normally neutral means rate hike, pause, and rate cut. So it can confuse markets even more. So that's why I'm saying if you have to change, possibly calibrated tightening is the clearest way to kind of indicate that RBI is in a war footing as far as inflation is concerned. The second thing is that this liquidity that RBI is talking about, bringing it to neutral. I think you should not link the repo rate hike neutral to the liquidity neutral, because that can the two timelines can be different. For example, RBI has been saying that they want to first reach the pre-pandemic level of 515 on the repo rate, right? So then after that, if they hike more, say towards 6%, you could say that is the incremental actual tightening that RBI is doing. So you can say that as calibrated tightening. But if you have to wait for liquidity to come down towards neutrality, or at least 2 trillion surplus from 5.5 that we have now, that will take a longer time period. So you need not kind of link both the things together, which then, otherwise what will happen is RBI can continue to, say whatever they want about the stance, but market will follow more about, the rate hike expectations, what Ananth was saying, 7% terminal repo rate, that kind of a view, without giving too much importance to what is RBI saying about the stance.
Okay, and I think some of this they don't even use the word stance anymore, so we're all splitting hairs. Nobody knows whether what they're putting in the resolution is what we traditionally know as stance or not. Ananth, just talking a little bit about liquidity, you made the point that even organically we may see a drawdown of liquidity to a considerable extent within this year itself, which probably explains why they didn't feel the need to do a CRR hike. But even down the line, you think they would probably not need to take any more liquidity tightening measures?
So I'll tell you how I see the math, Ira, at this point in time. You have, as Kaushik mentioned, 3.5 lakh crores of surplus banking liquidity right now, plus 2 lakh crores that the government is sitting on, which could be front-loaded and expanded at any point in time. So you have about 5.5 lakh crores of incremental liquidity. Now, currency in circulation, if you say is going to go up by 10%, 15%, take a pick, it's 3 to 4 lakh crores over the course of the year. Now, the big joker in the pack is currency, the foreign currency sales that the RBI will have to do. There's very little doubt that we will have a balance of payments deficit, which means the RBI will have to sell dollars. But the question in my mind is, do they sell in the spot market or do they sell in the forward market? Now, given that reserves are already at that critical $600 billion level, and there was a lot of confusion about 640 to 600, was it all sales of RBI, etc. I think optically the RBI might want to show the level of reserves as unchanged and actually sell from the forward purchases that they have already. Now, if they sell from the forward in the forward market, it will not show up in the liquidity impact, right? Because it's a future contingent kind of a liability. So to that extent, therefore, liquidity might not drain down the way the market is expecting. Market is expecting, RBI will sell 40, 50, $60 billion over the course of the year, and therefore there will be a drainage in the liquidity. So that's the first point of contention. The second is what RBI wants to do with respect to managing the government borrowing program. Now, Operation Twist seems like the cleanest option. In fact, the governor mentioned it while he was trying to warn all of us not to read too much into it. He did mention the fact that RBI has the space to do Operation Twist, which will not impact immediate liquidity. But if they want to go beyond that and to start doing OMOs to at least some token amount at least, at that point of time, they will be injecting liquidity at a time when they and plus of course buying bonds and managing the yield curve at a time when they're also trying to hike rates and normalize monetary conditions. It's pretty confusing. So I think a lot depends on that. If they need to buy a lot of bonds, I suspect that they will be penciling in some amount of CRR hikes to give them the space to do OMOs if required. But I don't think it's the primary option for them. So the way I see this panning out, I don't think RBI will sell in the spot market. It will probably sell in the forward market dollars, which means that the liquidity drainage on account of currency will be less than what the market is expecting. To that extent, liquidity might remain in surplus for a while. And they will let it remain because the governor has said 2-3 years for normalization of the liquidity. So he will let it remain. And on the bond side, I think they're trying to do as little as possible in terms of actual physical intervention from the RBI. And they will probably restrict it to Operation Twist and not really look into the OMO section at this point in time.
Yeah, I think just that comment on Operation Twist seems to have calmed the markets, even though there was nothing announced. Kaushik, your thoughts on how you expect liquidity to play out from here on?
So the Currency and Finance report is a very useful reference point. If you've seen the latest report, they mentioned that 2.5 trillion of surplus liquidity is okay. Beyond that, anything 1% of NDTL adds about 60 basis points upside to inflation over a 1 year period. So obviously RBI would want to reduce liquidity from the 5.5 trillion that we have at least to 2.5 trillion. And the governor had mentioned that they want to reduce liquidity to the pre-pandemic levels. Now, if you look at the pre-pandemic levels, December, January, February of 2020, even then liquidity was surplus to the extent of 2.5 to 3 trillion. So I'm expecting the first stage RBI would want to achieve liquidity surplus of 2.5 to 2.5 trillion from the 5.5 trillion that we have. Just to give you some numbers, currently liquidity surplus in the banking system, 5.5 is about 3% of NDTL. So you would want to get down to 1.5% of NDTL. So you need to reduce about 2.5 trillion liquidity from where you stand today. Out of which I would expect at least another 50 basis points CRR hike coming by the end of September. Why I say September, not October? Because after the August policy, I think the next policy is 30th September. So, possibly RBI can announce a 50 basis points rate hike in the September policy in the CRR, and that can withdraw about 900 billion, liquidity at that point of time. And the rest, as Ananth said, currency circulation, BOP deficit, all these things will play their role in withdrawing liquidity, even the credit growth going up. But on the other side, RBI can possibly add to a little bit of liquidity if they are concerned on the 10-year government bond yields part. So, net, I think by the end of this fiscal year, you are back to liquidity coming down to at least 2 trillion surplus, if not closer to neutral, and that can happen sooner also. But RBI governor has mentioned that if liquidity tightens a little bit more than what we are expecting, then you have the repo window by which people can take recourse to taking liquidity from RBI. But the point is that we are in a rate hike cycle. We are not in a rate cut cycle. So ideally, the liquidity should be in a deficit kind of a mode, not in a surplus mode or not even neutral. Now, assume that they will keep liquidity slightly surplus to manage the productive needs of credit or whatever. In that case, the price of liquidity needs to be higher. In that respect, my thought process is that the terminal repo rate needs to be a bit higher, and that's why I have 650 as the terminal repo rate in this cycle. Probably by the first half of FY24, we should get there. But by the end of this fiscal year, we should get to 6% is what I think on the repo.
Just a couple of quick words on the macros. Ananth, on the inflation front, you mentioned there may be upside risk even to these numbers. Where do you think the key sort of pressures are coming in from right now? Is it still oil, global food prices filtering through, or is it now increasingly generalized and hence the basket that is contributing is much wider?
It's all of the above, Ira. So to start with, the RBI was transparent this time in saying that they've taken $105 as the average cost of crude oil for this year. If you go by the futures, the average cost for this fiscal year is about $110 already. So, I mean, of course, it's very, very volatile, so one doesn't know where it will settle, but that's already there. Second, there's been an incomplete pass-through of the changes in the crude oil prices in the actual domestic prices of petrol, kerosene, etc. I put it at a shortfall of as high as 16 to 18 rupees right now in the nature of the pass-through. Actually, petrol and diesel prices need to go up substantially to ensure that the oil marketing companies don't have a hole in their books. Power prices, even though some states have increased power prices, the tariff pass-through is not complete. Coal prices, as you know, are at record highs at this point in time. Likewise, you also have input costs, feedstock costs, agricultural input costs going up dramatically. Yes, they have increased fertilizer subsidy, etc. But despite all of that, I suspect that the MSP increase will have to be substantial, given the simple rise in input costs. So all of this put together, plus what you mentioned about generalized inflation, the fact that almost every single heading under inflation is showing pretty high numbers, and the fact that contact-based services are coming back, which means we probably will see more activity there as well. All of this doesn't look good. Now, the good news is, hopefully commodity prices follow the path of the futures and therefore come down over a period of time. That's who knows. Hopefully supply chains start to debottleneck towards the end of the year when China opens up again. But these are all imponderables at this point in time. If I go simply by what the futures indicate right now, even with incomplete pass-through, as I mentioned, I see over 7% as the average CPI through the course of this fiscal year, with a peak around August, September of this year. So yes, inflation is looking like a problem. On growth, by the way, things are looking a little better. PMIs have been pretty robust. Anecdotally, services coming back, it seems to be pretty strong. Hope and pray that the COVID wave, and do get well soon, Ira, that the COVID wave doesn't sort of blow over again. So yes, on the growth front, things are looking reasonably okay. One quick worry I have on the growth front, besides everything else, the war, etc., the transmission of rate hikes into growth will be a lot faster this time around. 40% of all outstanding bank loans are now linked to the external benchmark rate. So a lot of the risk of repricing of the repo rate, the CD rates, etc., will pass on to borrowers, and most of them are to our retail and SME borrowers who are linked to EBR. Second, a lot of banks made immense profit by selling securities from their held to maturity book over the last 2 years because your yields were at a record low. In some cases, the profits were almost 100% coming through from bond sales. Now, this time around, you not only have no profits, you actually have losses, which you don't have to recognize because it's under an accrual book. But the drag, if the repo rate does go to 7%, will be immense. You will actually be sitting with assets which are earning less than what your marginal cost of funds is. That again can lead to transmission being very, very quick and high as far as borrowers are concerned. So do not underestimate the possible impact of a rapidly normalizing monetary policy on growth and an uneven nascent growth going forward.
Oh, absolutely, and that's a great point. This is the first time under the external benchmarking regime that we'll see such a steep rate hiking cycle. So interesting to see the impact. Kaushik, this is something that I know journalists are obsessing about. You have to be sympathetic that there is a global sort of problem that is feeding into inflation, but they will miss that their target by 3 quarters, so they will have to go through the routine of explaining themselves to the government, etc. That's the RBI deemed failure under the new monetary policy framework. Not much to say beyond that, except say that, well, it happened.
See, the thing is, what Ananth was saying, the transmission will be faster, and you actually need this if you want to bring inflation down below 6%, durably, not just 1 quarter because of base effect. I mean, I'm more interested in looking at what I'm forecasting for FY24 on inflation. Is it coming down to 5%, or is it going to be 5.5% to 6% range? And I'm not getting a confidence that it will be at 5%. I'm getting a range about 5.5% to 6%, and it can always have an upside. So only when you increase interest rates aggressively and you actually curtail demand to some extent is when after 3 quarters or so, you'll see actually that filtering into the real economy, growth slowing, and you need that if you are really going to get inflation down to 5%, 5.5%. RBI's target is still 4% unless they change that at some point of time. Just achieving below 6% is not good enough. So to that extent, I would expect RBI to continue front-loading rate hikes, reach to a level so that next year's growth and demand to some extent slows down. In fact, I have a lower growth estimate for next year precisely for that reason. I have close to 6% growth, which could possibly downside risk, whereas the Bloomberg consensus is about 6.5% on next year's growth. I'm more concerned about not this year's growth. It will be more about next year's growth. So I guess in order to get the inflation back into the tolerable range, and inflation expectations also is a very important thing. But once people start expecting, okay, inflation will be 10-15% higher, this will beget more inflation and inflation expectation going forward, and there can be a wage price spiral at some point of time. So you don't want that to happen, and therefore you need the front-loaded data. Therefore, I was saying calibrated tightening, which will give a very strong message that RBI is on a war footing against inflation. So taking all this together, I think next year's numbers are important to calculate the Taylor rule formula. So I use next year's inflation of about 5.5-6% and growth about 6% on an average. Then you assign some real interest rate. What positive real, which itself can be a big debate, what RBI will work with. I'm assuming about just a positive real interest rate of 25 basis points positive, not 1 to 1.5% positive that we used to have. You'll get a Taylor rule estimate of about 6.5% or even higher if you do that. So from that standpoint, I think policy repo rate needs to go up. If you need to reduce inflation sustainably towards 5% or lower, which I think will be very challenging. I think after this COVID, the new normal for India's inflation would be about 5.5% if you are lucky, and growth would be about 5.5 to 6%. But the nominal GDP growth would be 11% because inflation would be 5.5-6%. So those are the estimates I'm working with while kind of trying to determine the terminal repo.
Fair enough. And then just the last question from a market perspective, I think we saw yields take out 750. Must have come off a little bit today. I haven't checked the latest numbers. But broadly, the pressure on yields will continue until the RBI draws a line in the sand if it comes in with an operation twist or something to that. Most people are saying that 8% is not unthinkable for sure.
Sure. Yeah, it did come down to about 7.44% on the 10-year. It's, I think, back again to 7.5% now with the relief having kind of subsided. Absolutely, I think 7.75, 8 is not unthinkable, particularly since RBI does not have too much of ammunition in terms of actually being able to buy tons of bonds. I think unlike last year where they stood up and did a GSAP and all of that, you simply can't do a program of that size and that nature at a time when you're tightening monetary policy. It doesn't make sense. So they will do Operation Twist, I think, at some stage, but they will do it in a very measured quantity. I don't think they'll want to go berserk on this. The forward market, by the way, for 10-year bond yields are indicating that they will head towards 7.75 and 8% over the next 1 year. Couple of quick other points here. One is that actually the longer end of the bond curve is not going up too much. It looks like insurance and pension fund demand is still reasonably good. The problem is really in the 10-year and below point where bond banks are also sort of shy about buying a lot more of bonds. That needs to be handled. Second, I'm hoping that the actual borrowing program for the government actually comes down. Last year, if you recollect, Ira, it was 9.7 lakh crores budgeted. The final borrowing number was just 8.1 lakh crores because you had much more collections in small savings, you had other collections coming through, and therefore the gross number came down. This year, despite the increased expenses and despite the lower fiscal, the lower excise duties on fuel, etc., I'm guessing that the actual borrowing program will be lower than the 11.5 lakh crores as well. So combination of all of this and with yields going up, I think the bond program will get kind of managed. 7.75, 8 is a possibility, and those are probably good levels for long-term buyers to step in, to be honest. Bond yields above 8% in India have not sustained for too long, and they've generally turned out to be good buys after 1 or 2 or 3 year time frame. So yeah, looks like that.
Kaushik, anything to add?
The point here, I was just going to resist, and I would want Ananth's remarks on this as well. If you kind of see the difference between US 10-year and India 10-year, normally the average has been about 4.5%. So with US 10-year being at 3%, 7.5 on 10-year is not too out of whack. So it's kind of within the range, and RBI has allowed that to happen. So the call that we also need to take is, where do we expect US 10-year Treasury 6 months down the line? Is it going to be 3.5%? If it is 3.5%, definitely you'll have 10-year bond yields heading towards 8%. Just from that global point of view, even if things are improving in India. So that global beta you have to keep in mind. If you remember, a few days back, the 10-year Treasury was coming down, and you saw US, India 10-year bond yields also coming down. Last few days, what has happened is US Treasury has gone up, and also the oil prices have gone up, and the YS curve had gone up, and 10-year GSEC also went up to some extent. So the point is, if you also want to ensure that you don't want too much depreciation on the rupee front, there has to be a certain differential maintained between the US Fed funds and the India 10-year. Therefore, I would, as long as US 10-year is at a particular point and the spread is 4.5%, I don't think RBI will be that concerned. But if it is the case that US 10-year is not moving and India 10-year is moving for domestic reasons and moving too fast beyond RBI's comfort, then RBI can come and do something to temper the bond deals to ensure that you don't have a disorderly kind of a movement in the bond market.
Ananth, you think that will be a major factor in when they decide to intervene, maintaining a certain interest rate differential between US yields and local yields?
I think it's a fair point. If you look at, for instance, you remember that 1 year ago, not too long ago, 1 year, 2 months ago, RBI was talking about 6% being the line in the sand, public good for the 10-year bond yield. Thereafter, to be fair to the RBI, they did allow bond yields to go up quite dramatically in sync with what happened to US Treasury yields. US Treasury yields moved up from below 2% to all the way up to 3%, and we kept kind of pace with what's happening globally. So yes, I do see, we will be in sync with what's happening with global fixed income markets as well. I do just see the connectivity with US Treasuries. But yes, obviously we have our domestic factors. The point is, RBI does not want to expend too much of ammunition protecting the bond markets at this point in time. At the same time, it has a tough job of managing the overall government borrowing program. Remember, states haven't started borrowing in big measures yet. GST has to be revised. We don't know what's going to happen on GST compensation. So lots of imponderables. We could see unpleasantness until this rate hiking cycle continues. But I guess the hope is that at about 8% or so, genuine buyers will start emerging. Maybe retail investors like you and me will start getting incentives. Finally, the tax exemptions will come in to allow us to start making investments in the government securities. If all of that happens, I think we should be able to manage up to 8%. It will be bad news for banks. It will be bad news for borrowers. As I said, transmission costs will be quite high. But this is just one of the many balls that the RBI has to juggle. Unfortunately, not all of them are compatible with each other.
Fair enough. I'll leave it at that. Thank you both so much, Ananth and Kaushik, for joining us here on BQ Prime.
Thank you, Ira.
Thanks for watching.